Hello, everybody. Welcome back to another edition of the Wealthologist Live. Chris Hobart here, the Wealthologist, and today we're going to be joined by, I got to say, two of the sharpest minds in business. And no, I'm not talking about myself. That's not us two. There's somebody hiding in the wings right now. So obviously, we're going to have our lead investment strategist, Jacob Woodrum, who's with us every time. And then we're going to have our in-house expert on planning. And also, we're going to be talking about fraud protection today with Andrew Greer, one of our senior wealth advisors. So, Jacob, good to see you.
Good to see you too, Chris. Good to be here,
Yeah,
as always.
Yeah, as always, right? We always talk about family as we let people log in a little bit.
Yep.
What's going on in the Woodrum household?
Yeah, so we're gearing up for Thanksgiving. I can't believe it's that time of year again. And full disclosure, we've already put up our Christmas stuff too. So we'll be traveling up to West Virginia next week to hang out with my family. So it'll be good.
Right. Good. Yeah, we did the Christmas stuff this week as well, which felt a little bit earlier, but so Sloane's at college. My oldest is at college, and she's coming home. She's actually coming home a little bit earlier. It's the weirdest thing. College professors, they cancel classes like that anymore, and I'm kind of like, we're kind of paying for this, but don't get me started, Everett. Don't get me started. Anyhow, so she's coming home a little bit early, and she told Renee, she said, "Mom, I would love it if the house was decorated for Christmas." So last weekend, I'm sick as a dog, but here I am, like taking stuff down out of the garage, and I'm just like, all for the love of our children, I tell you. So that's where we're going today with that.
Yeah, tis the season.
Yeah, tis the season is right. All right, so let's go ahead and dig in. If you joined us before, you know what's coming. We do a segment called the 3-2-1 for those of you that are new. What we do is we share 3 economic insights that are kind of impactful right now. We talk about 2 portfolio strategies that we're actively using, and then 1 financial tip that could really help your future. And Jacob, you are going to lead us through the first 2, as you always do. And then then Andrew is going to wrap up with that 1. And then we're also going to have Andrew do the quick fire Q&A. We've got some great topics today for that kind of end of year planning. So Jacob.
Yep.
Are you ready?
I'm ready.
All right. Well, if that's the case, take it away.
Perfect. Thank you, Chris.
Yep.
So what I'd like to talk about today, and I've got really 3 topics, specifically. The first is what I call kind of big earnings but a small reaction. And we want to start with really companies that are reporting. So, most of the companies in the S&P 500 that have shared their results for the quarter, they've done pretty well, way better than analysts expected. And we've got a chart that I want to show that helps to kind of help visualize this. But, you can see this really over the past, 3 or 4 years, what the actual earnings have been quite a bit better than the consensus. Even when we had some negative earnings, 2022, 2023, they weren't as bad as what we thought they would be.
Now, help me understand this chart, though. I understand what you're saying, but what are we seeing? Obviously, we see nice big blue lines, in 2025, 26, really even going higher. So what's that actually mean?
And that's what I think really stands out to me, Chris, which is, moving into the remainder of 2025 and into 2026, we are expecting continued earnings growth. Now, we'll see how that shakes out. We're always going to have to play it by ear. But I think the thing that I want to at least highlight in this slide was that we've seen, and really since 2022, we've had one of the strongest periods of what we would call earnings beats, since really post-COVID, right around 2020, 2021. But I think the strange part is that even though companies are beating expectations, as we're seeing on the chart, stock prices haven't really jumped, at least recently, how they normally do. Because usually a big earnings report or beat kind of leads to a nice bump in the price of the stock, but this time the reaction's been pretty small. So the question is, well, why is it happening? A lot of investors, I think, are still, unsure about the bigger picture, because we've got things like inflation and interest rates and these global events. And so, the overall market's kind of already priced in pretty high. So it takes more than a great earnings report to move these stocks meaningfully. So I think the big message here, is kind of simple. It's where diversification matters. And so, with uncertainty high, reactions being muted, having this money spread across different parts of the market really helps us to keep the portfolio steady while still giving ourselves room to grow.
Yeah, and that's kind of that concept of talking about broadening the plan. it's so easy to look at like the Mag 7 and to want to go heavy there. But it's a good reason to broaden it out, because at the end of the day, strong earnings, they don't always translate into strong markets, specifically when confidence is shaky. So good plan.
Yeah.
All right. What's next on our list?
Yeah. Second, the theme that I have for the second point is AI isn't going away, but I think the winners are going to start to broaden out, kind of to your point just now. So let's talk about tech, because I think tech has been the main driver of the stock market for many years now. And a big part of that has been the excitement around artificial intelligence. And I think it's warranted, frankly. But, and we've got a good chart, I think, on this one as well. Investors really have been pouring money into companies building AI chips and cloud systems and this advanced software. And to be fair, a lot of these companies have the earnings and the balance sheets to back it up. And that's really what we're seeing on this chart, which is showing the Magnificent Seven, from a price to earnings perspective, and how earnings have been going up since, January of 2023. And then we've also seen really decent, performance. We saw obviously a pullback at the beginning of this year, but we've seen good performance. But I think this chart is telling, because we're starting to see, really over the last, quarter or two, we're seeing earnings from these Mag 7 companies starting to kind of level out a little bit. And I think as we move into this next phase, things are probably going to shift a little bit. So these big tech stocks that have gotten expensive, and small group of companies that have really been carrying a lot of the market, I mean, it certainly does create risk if these companies start to slow down. So it's something to pay attention to.
Well, I mean, they're driving the majority of the growth in the S&P 500, right? I think what's interesting, and I think we talked about this last month, is this is different than what we saw like with the .com issue back in early 2000s, late 90s, where there really wasn't support. I mean, the nice thing that we see with this chart is we are seeing that these companies are making money. It's not like, again, the .coms, they were...
that light blue line in the .com chart would show negative.
In the wrong direction. Which I think that is the important thing to look at, because a lot of one of my first jobs was in the .com world. When I think of the AI, there's always that feeling behind the scenes with that. But at the end of the day, understanding that these companies are making money and there is something behind them makes a big difference. Now, again, what that means long term and how all these companies pan out, we're going to see. Yeah,
and I think the key is, instead of betting on only the biggest names, we still want to have allocation there, but instead of betting only on the biggest names, I think it's a really good time for us as investors, of course, to stay diversified, but look across the market. And that's what we've been doing. A lot of potential growth areas or growth in areas, I think, that just haven't been quite in the spotlight yet. So, again, some opportunity.
Oh, and that reminds me, I mean, we recently had a client come in, I think it was like last month, that was nervous about having too much tech exposure. She wanted to benefit from AI, but without betting the whole farm on one sector. Smart. And that's where we were able to help her reposition her portfolio to be a bit more balanced, but also keeping her growth potential strong. Because again, you don't want to lose out, but you also don't want to, be all in and have things go the wrong way. Again, .com, that's what happened 20 some odd years ago now. That's a long time. Oh man, I'm aging myself. I guess I should see that I've got white hair, so that kind of fits. All right. What's next?
Last topic. So my theme for this is Magnificent Seven. It's not the only show in town anymore. And again, this kind of piggybacks off of what we were just talking about. But, again, we know what the Magnificent Seven is, a handful of huge tech companies that have dominated. And they've done incredibly well, stock performance and in earnings. But I do believe, we're kind of at this point and past the stage, possibly, a lot of the data points to this, where those seven companies, have been leaving everyone else in the dust. But I think that's about to change.
And tell everybody who the Mag 7.
Yeah, so it's, Apple, Microsoft, Amazon, Nvidia. It's the top seven names in the S&P.
All the ones all the ones when you're talking to your friends, they're sitting there saying, I wish I bought that when it was at $1.
Right. So I've got a good visual on this as well. This is my last one for here. So 2 years ago, and based on this chart, you can see just 2 years ago, earnings for the Mag 7 grew almost 40 percentage points faster than the rest of the market, which is pretty wild. Analysts now are expecting that gap to shrink to around 11 points. They're still strong. Those Mag 7 companies are still strong. They're not going anywhere. but I just not just as far ahead. I think they're going to move as before, and so there's just some opportunities. And it is interesting. I mean, you look at 2023. I mean, 74% return attributable to the Mag 7 versus AI exposure X Mag 7, 40-ish, 44%, and we're just seeing that shift now, right?
That's great fancy talk. X Mag 7. So come on,
you guys know me well enough now. I know. So for the other 493 companies, right, of the S&P.
There you go. Thanks. I mean, that's all you had to say. You just had to say
Chris keeps me on track.
Mag 7 and the other guys. You know what? I think what's interesting though is 2023 was obviously gangbusters year,
right?
But 2022, how was it for those?
Rough, very rough.
Yeah, I mean those. So when we see that, that's
down
a lot
30,
of that's a lot of rebound built in there as well.
Right.
Whereas the rest of the market didn't have that type of loss to justify that rebound as well. So
and that's a great point. Being able to just, and that's a good lesson too, Chris, really is, it's very easy for us to get lost in the data or maybe just look at one subset of data, but seeing that big picture is so important.
Yeah.
Very important. So I think to wrap this piece up, if we want to benefit from the broader AI opportunity, I think moving forward, it's going to be more and more important for us to really take more of a kind of a selective approach. And I think the bottom line is, the next wave of winners might come from beyond the Mag 7. And so I think investors who, are looking across the market, could really find some potential compelling opportunities moving into 2026 above and beyond.
Jacob, I know your phone's going to be ringing now, and people are going to be saying, "What are they, Jacob?" So so you can ping him.
They're not hot stock tips.
Yeah, there you go. Well, that's great. I think those are great kind of economic updates as we're kind of going into the end of the year. Now we are going to go ahead and shift into the number 2 of what we do, which is the 2 portfolios that kind of are working right now or have a compelling story. So if you would go ahead and share those with us.
So I've talked about these before, both of these 2 strategies, and I'm bringing them up again today just because I think it really points to what we were just talking about with market concentration and where things are. But the first strategy, Income Growth Plus, it's dividends while we grow is the idea. It's a portfolio, a strategy that balances about 60% in stocks, 40% in bonds. But our goal is to provide regular income through dividends. It's currently paying a little less than 4%, so it's kind of close to a bond yield.
Now, when you say paying, that's not the growth, that's the distribution.
Right.
And I think that's the important thing. Again, always looking at this kind of like real estate. The value of your house can go up, and you have renters that are paying you. You're talking that 4% yield or distribution is the rent, but the value of the property can still go up or go down.
Yeah. So. Well, a good example of that is, this year we're still up about 10% on the year. We're getting and that includes the dividend, but we're seeing growth as well as the income, which is exactly what we want to see. So, I think it includes more stocks than traditional bonds, so it's got more potential to grow and it is more value focused. But why I like it right now in this environment, we talked about the overexposure on the Mag 7 and kind of tech growth side. This strategy really doesn't have a lot of technology. It's more invested in value, which is meant to pay dividends. And I like that. I think it makes a lot of sense.
Yeah. And here's the thing. If you're comparing everything to the Mag 7, this is going to feel very boring.
Yeah, that's a good point.
But we can't compare everything to the Mag 7, right? It's kind of like you're driving your car and you compare everything to a Ferrari. You will be disappointed because you're going to be sitting there saying, oh, I don't have a Ferrari. I drive whatever. With that said, you also don't have the risk of the Ferrari, the insurance, the tickets, everything that comes with that.
Tires, change the brakes.
Exactly. And the Mag 7, boy, I mean, huge gift giver, right? But also, I think of what the portfolio you're talking about. This is a great portfolio for clients who recently retired, especially those who want that steady income without locking themselves into kind of ultra risky positions.
Yeah, I think that's perfect. The next strategy, the last point that I'll make today, is our dynamic tax efficient select. So it's smart growth, it's tax savvy, and I really, really love this strategy. Again, we can track an index, so we could track the S&P, we could track the NASDAQ. So if we're tracking the S&P with this strategy, we will have Mag 7 exposure, because that's what we're doing. But what I like about this is, we're going to grow when the market grows, but we've got this added flexibility because we can look to actively offset by tax loss harvesting within the strategy. And so, if the Mag 7 doesn't do as well over the next year or two, or we see a pullback in the market, we can take advantage of that because we have the ability to loss harvest, and we can really take a negative situation and turn it into a positive. So it's really powerful. And then we can also invest in a strategy like this more from a values-based perspective. If we want to be socially responsible, we can be very customized in our approach, which I think is just really unique, and you're just not finding that much in those types of investment strategies with most folks.
And I gotta tell you, I think this is something that really makes a lot of our planning special. I find that so many people, they have cookie cutter, right? It's right. You get, I don't want to pick on any big name companies that are out there, but it's like plug into a portfolio and that's that. What we're talking about here is, the ability to have personalized tax smart growth that's also values aligned. And I gotta tell you, I love this concept because we were talking about this before. We're seeing people that are getting the returns of the S&P in a good year, and they're also able to bank losses because we're doing tax loss harvesting. So I think of all the people that are just in the S&P mutual fund, they're getting the growth, but they're not getting the tax losses. And that little extra right there can be huge. And
you're actually paying for, if you're in the mutual fund, you're having to pay for it every year too. So it is a big, it's a huge value.
It is. Well, Jacob, I appreciate your perspective on that. If you've got any questions about any of these, please reach out to us. I will tell you that the two concepts you talked about today, phenomenal portfolios. Again, the second one I really like just because it addresses taxes, which so many of our clients are concerned about and wanting to do whatever they can to get Uncle Sam out of their back pocket. But both of them serve a great purpose. So thank you for sharing those. I think they can make huge differences this season. But hey, that's all you get to talk about today.
That's a wrap.
That's a wrap. So thank you for coming in. We are now gonna go to the one segment of our program, and this is going to ask Mr. Andrew Greer to come on in. So Mr. Greer, welcome to the show.
Thank you. Thank you for having me.
Yeah. Well, and just like I asked Jacob, what's going on with the Greer family?
Oh man, we're doing great. Busy, very busy. We very quickly turned into the family that's just kind of chasing their kids around all week.
Between 8 and 5,
soon to be 9 and 6. Basketball, swimming, tennis, gymnastics, golf. And I don't recall too much of a ramp up period either. It just happened overnight. So here we are.
Yeah. Well, just wait. Then they're going to go to college. And again, and what's so weird is I remember clients years ago telling me when Sloan and Blythe were so teeny tiny, like it goes quick, and holy smokes, it goes quick.
It does.
I think Renee, my wife, always said, what is it? Short years, long days, I think it is, or something like that. And that's true. Yeah. And that's definitely true. Now, just because they go to college doesn't mean that that you care any less. In fact, I've got a business coach, and he also coaches my daughter a little bit too. And he recently told me and her, he's like, yeah, your parents are what we call helicopter parents. And I thought,
oh no,
yeah,
the dreaded title.
Yeah, I know. I thought, oh, thanks, Steve. So now every time we bring up a suggestion to my daughter, guess what? She calls us out. She's like, don't be a helicopter parent. So anyhow.
Could be worse. Yeah. Could be worse.
Yeah. Could it? No. All right. Let's go in. So Andrew, when we were talking about what value we can bring to clients today about this topic, we got a meaty one today because it's important. What are we going to be talking about?
Yeah, so a little bit off script, but today we're going to be talking about something that's obviously very important, which is the rise in fraud, scams, and identity theft, especially targeting retirees and pre-retirees.
Yeah.
Every year these schemes become more and more sophisticated. Criminals are getting better at impersonating banks and government agencies and even your own family members now. And now they're using AI to do it.
Well, I told my team just the other week, I was copied on an email to our billing department, and the email had a conversation between me and somebody else.
Yeah. Yeah.
But it wasn't an actual conversation, but they had my vernacular, they had everything down, and they were saying, hey, pay this bill. And I checked in, I said, hey, we haven't paid this yet because this is not real. And the person said, oh, I was going to pay it tomorrow. And fortunately, we caught it. It is that good. So good news is, they're going to pay it tomorrow after they had talked to me. And that's always our process. But I know you've got a lot of content here, so let's dig in.
Yeah, we'll zip through it. But we've all benefited from AI at some point at this point in time. But we also know there's a downside. This is a perfect example of that. So, today I want to walk you through some of the most common scams that we're seeing right now, how AI is changing the fraud landscape, how to spot red flags before damage is done, how to stay vigilant online and over the phone, and what to do immediately if you think your information's been compromised. So again, a lot to unpack, so let's jump in. First thing we want to cover, current scams that we're seeing. And let's start with what we're seeing happening out there today. Here are some of the top schemes that we're seeing targeting our clients this year. So the first one is imposter scams. These are messages from someone pretending to be the IRS, Social Security, Medicare, Amazon or Apple, your bank, sometimes a fake tech support team.
In North Carolina, the interstate pass. You've got a bill to pay. I'm getting those all. They've died down a little bit, but getting them all the time.
Yeah, and the message, as you've all probably received one, usually says something to the effect of, there's a problem with your account, click here or call this number immediately. These are almost always scams, right? So you got to be very, very careful with that. Another one, fake financial alerts. These are very popular and convincing. You might get a text that says, suspicious activity detected on your card, reply yes or no, or a call saying that your investment account is locked. If you didn't initiate the call, assume that it's fraudulent, okay, as a rule of thumb. Another one, romance and caregiver scams. These are targeting people who may be isolated or overly trusting. Someone builds a relationship online, then they ask for money. Let's see, we've got phishing emails and texts. So these are messages that look legitimate, but are designed to steal your passwords or download malware.
Yeah, I saw one recently. It was from Microsoft, and it looked just like it, but the M in the email address on the email address was an R and an N, and those two together, that looks like an M. So it was actually Renais Microsoft. So I guess that's how you pronounce it. That's the official term.
Is that part of the Mag 7?
Yeah.
All right, so now let's talk about some scary new ones. These are AI-driven scams that you need to know about. So AI voice cloning scams. Criminals can now clone someone's voice from just a few seconds of audio, maybe pulled from social media, a voicemail, even a video clip. You might receive a message or a call that sounds exactly like a grandchild, a spouse, a financial professional. They'll say that they're in trouble or needing money urgently. Always verify through a second known phone number before acting. Okay. Deep fake videos or FaceTime scams. This is kind of an emerging class, but growing fast. Scammers can create fake videos of someone that asking for help or sharing urgent instructions. If a video call seems off, you got to trust your gut on that. Trust your instinct.
And even if it doesn't feel off, it is trust but verify type of thing. You've got to be these days. Some of the AI stuff that's coming out is, it is so realistic. Yeah. It is impossible to really know at times, and that's what's so scary.
Yeah, even in the news, I don't think I trust much of what I see at first glance. I'm usually doing some back-end research to verify even what I'm seeing on the news.
Yeah.
So, unfortunately. Hyper-realistic AI emails and texts. AI tools allow scammers to create emails that sound exactly like your bank's language, kind of what you were just talking about. Perfectly written messages from a family member, personalized emails. They're cleaner, they're better worded, and really harder to spot. Let's see. AI-generated fake investment opportunities. We're seeing highly polished fake investment newsletters, AI-generated images of successful projects, ads featuring deep fake celebrity endorsements. If an investment or product is being pushed aggressively online, you got to be cautious. Okay. So real quick on how to spot red flags, not every suspicious message is obvious, but most scams, including AI scams, share the same warning signs. And one of those warning signs is the sign of urgency. If someone's pressuring you to act immediately, that's a red flag.
Just as a quick aside, we have a client that we spoke with probably 6 months ago, and they got a call, and it was about their crypto wallet. So nothing that they had to do with us, but they were calling because they got a call about their crypto wallet that said, "Hey, we need to immediately transfer these funds. Your crypto wallet's been hacked. This is what we need to do. You need to log in. You need to do this. Boom, boom, boom." Mm-hmm. They did it, and they transferred all of their crypto that they've had for 5 years, 6 years to an outside source. And what happened in that process was that person then called the wallet company that held the crypto and said, "How do I get it back?" And they said, "Once you've transferred it, it's gone. That was your decision." And this person, not somebody that does not have their wits about them, not somebody that doesn't question. It was urgent, and they knew enough about this person that it was just like, okay, got to do it and got to do it quick.
Yeah.
So,
yeah. Another one is requests for personal information. No legitimate organization will ever ask you for your social security number, bank logins, one-time codes, full credit card numbers over email, text, or an unexpected phone call. Let's say requests for strange payment methods, gift cards, wire transfers, crypto, all big red flags.
The IRS does not settle your debt through gift cards. So if they're like, "Go get us an Apple gift card, it'll settle your debt," not going to happen.
Yeah. And I think this kind of ties it all in. Emotion manipulation. AI scams often use panic, fear, or urgency to override your judgment. So again, how to stay vigilant, couple practical habits that you can protect yourself every single day. Rule of thumb, slow down. Pausing even 10 to 15 seconds can prevent 90% of fraud losses. Verify everything. If you get a message from a bank, government agency, or even a family member, call the number you already know, not the one that was provided in the message. Goes without saying, use strong, unique passwords. Your email password especially should be strong and different from others. Two-factor authentication. If you suspect that your credit has been stolen, freeze your credit. So if you're not actively applying for credit, keep your credit file frozen.
Yeah, with all three agencies too.
With all, yeah, exactly. Review your statements regularly. Look for small unexplained charges. That's often how fraud begins, small. Limit what you share online. The less personal information, even on ChatGPT. I know it's tempting, but the less personal information on social media, the less AI has to imitate.
And a good point with this is sometimes you get on Facebook or something like that, and they have that list of, tell us 20 fun things about yourself. What's your first street you lived on? Where did you meet your spouse? What's your first dog's name, or what's your dog's name? And you're doing that, and everyone thinks it's fun. But what you're doing is you're creating a list of things that oftentimes are used for password verification. So just be very mindful of what that looks like. What's your first car? Okay, it was XYZ. Okay, they're trying to get into your credit card. What was their first car? Oh, I know that. They answered that question for me.
Yeah. So last one, what do you do when you think you've been compromised? So step one, stop engaging immediately. Hang up, don't click, don't reply. Okay. Step two, change your passwords. Start with your email and financial accounts. Step three, contact the organization directly. Use the number on their official website, as we were talking about earlier. Step four, freeze your credit. Again, this blocks new accounts from being opened in your name. Run a virus scan if you click the suspicious link. Very simple. And step six, contact us. As your advisor, we can help you. We can help you review accounts, lock down access, verify transactions, coordinate with custodians, and things of that manner. And last one, report the scam to the FTC or local law enforcement if needed. So the faster that you act, the better the outcome. So really the bottom line is scammers are getting smarter, especially with the use of AI, but so can we. If something feels off, trust that instinct, slow down, verify, and when in doubt, call us. At Hobart Wealth, part of our job is helping protect not just your investments, but your personal information and your peace of mind.
That's I got to tell you, in seeing the different people impacted and affected by this, that was a lot. One thing that we're doing this next month is we're going to be doing more of these as Hey Hobarts on our Hobart Wealth YouTube channel. So if you want more tips around this, we've got some Hey Hobarts that we've put together that should be helpful. Or if you just have some general questions, reach out to us. Again, as Andrew pointed out, that is exactly why we are here. Now, Andrew, before you jump off, we are going to do the quick fire Q&A. So we've got time for 3 questions. And as you know, 3 questions, very quick, very precise, and gives you an opportunity to show off to everybody your knowledge. You ready?
Let's go.
All right. First question is going to be, and this is there still time to do a Roth conversion before year end?
Absolutely, but you've got to act fast. So December 31st is the deadline, and we've been helping a lot of clients get that done early so they can relax through the holidays.
Okay, perfect. Now, how about question number 2? Should I harvest investment losses before year end?
Yes, if it makes sense. Tax loss harvesting, in a nutshell, it can help you reduce capital gains. So it's been a big growth year in the market, right? A lot of investments have been accumulating. And specifically in our non-qualified accounts, one action that we can take is to sell off of some of the losers to offset the taxability of the gains that we've been experiencing.
Yeah, and again,
deadline of December 31st.
And a little bit what Jacob's did. And the nice thing is, with some of our portfolios, we're managing around that, and we're doing that automatically.
Yeah, absolutely.
And that's really only important inside of your non-retirement accounts, just as a quick reminder. All right. Finally, number 3, are charitable contributions still deductible this year?
Yeah, they sure are. And qualified charitable distributions, QCDs, are one of the most powerful tools. As long as you're 70.5, which is the ability to gift to charity or church directly from your IRA, where it's not a taxable event.
Oh, that's perfect. Yeah, and again, the thing that I will point out is, we are nearing the end of the year. Don't have to tell you this, but as we near the end of the year, that simply means that if you've got something that we need to transition or take care of, whether it's Roth conversions, charitable giving, any of that stuff, we have got to make sure that that we essentially are doing it sooner than later. We've got a month and a half left, but really to get stuff done and get stuff done effectively, we got to do it a bit sooner.
Yep, agreed.
All right, Mr. Greer. Well, I appreciate that. Thank you for that. You know what? I'm realizing something. Usually we have stuff built in here for a transition, but I don't know if I actually have this. So people might actually, at this point, see the magic that happens. Let me. I'm going to press a button, folks, and see what happens. Oh, it's our Hey Hobart question. So go ahead, Andrew. You can scoot on over, and because we are going to go into the Hey Hobart segment. So the Hey Hobart segment it's probably one of my favorite things because this is where we take one of the questions that you provide to us and we give you a straight answer right here live. So today's Hey Hobart, let me pop that back up here. It is from, Diane in Charlottesville, Virginia. And she says, "Hey Hobart, I watch a lot of your videos on YouTube and know that you talk a lot about economic concerns." So real quick, Diane, thank you. I appreciate that. Nothing like a little ego boost. She continues, "I get worried about what's going on, the volatility, tariffs, etc. Can you give me some pointers as to how to calm down?" Oh, Diane, man, that is such a timely question because you're absolutely not alone. Here's the deal. Right now, we are living in a really noisy world. Markets are up one day. We've seen some volatility recently. Headlines are all the time. We're hearing about tariffs, inflation, recession. Even as we're talking about that, we're talking about some of these things. Sometimes it feels like you're riding an emotional roller coaster. But here's how I want you and anyone listening to calm that noise. I need you to take a moment, and it can be tough, but I need you to zoom out because most fears come from looking too closely at the day-to-day. And if you zoom out, and I'm talking zooming out over 3 year, 5 year, or 10 years, markets tend to reward patience. So you got to have a plan and you've got to know your plan. If your financial strategy is built to weather volatility, and we build all of our plans that way, then these short-term swings, they can happen, but they shouldn't shake you. They should be part of a planned process, but not really. I guess it shouldn't come as a surprise, and you should know that you can weather that storm. I, the thing is, if you're planning properly, you've got income buffers, you've got defensive allocations you can take, and you've also got flexibility. So that means with all of this in place, you can avoid emotional decisions, because emotional investing is usually bad investing. I got to tell you, it is okay to feel nervous, but don't act on those nerves without guidance. Stay informed the right way. And when I say that, don't accept everything that the news is constantly feeding to you, because it will drive you nuts. Diane, since you mentioned it, keep watching the videos on our Wealthologist YouTube channel, as well as our Hobart Wealth YouTube channel. We have two different kinds of content on there, because we provide a lot of feedback as to either what's going on or maybe things you could be doing in the current economy that could be helpful. And if you're not subscribed to our weekly newsletter, do so. We get that out every week on Wednesday. We unpack a lot of these concerns in ways that are clear and calm and hopefully helpful. I think the most powerful antidote to panic, it's a plan, right? If you've got a plan and you understand how your plan works and you understand your plan is moving forward, that's the recipe for success. And that's what we're here to help you with, and to build that and help you stick to it. All right, folks, that is going to be a wrap for this month's Wealthologist Live. I wish you a happy Thanksgiving coming up from all of us at Hobart Wealth, and that's to you and your family. We're going to be back next month with some 2026 outlooks, maybe some end-of-year tax prep tips, although it's probably going to be too late to implement a lot of those, and we're going to be talking about a lot more. So until then, I encourage you to take it easy, stay steady, and we'll see you next time. Have a great Thanksgiving.